All right, Matt, the mortgage guy here. Today's video, I'm going to be talking about non-QM loans. Non-QM loans, for those that don't know, aren't the conventional conforming Fannie, Freddie loans that you normally hear about. They're not hard money loans. They fall somewhere in between. So for somebody who's self-employed, maybe doesn't show income on paper, or just needs alternative financing, these loans are a great option. Before I get into it, if you like straightforward, honest mortgage, real estate advice, please do me a favor, smash the like button, consider subscribing to the channel 3 times a week, Tuesday, Thursday, Saturday. I'm putting out videos. Every once in a while I throw a few extras in there, but I'm trying to get information out that can hopefully help you in your home buying journey, your real estate investing journey, from a mortgage broker, giving mortgage advice, talking a little bit about real estate investing as well. So without further ado, I'll get into it. And in this video, what I'm gonna cover is not non-QM loans as a whole and 17 different products. The 2 most popular products, the 2 products that I do the most of, the ones that when folks come to me, they fit in one of these 2 buckets. These 2 loans are DSCR loans, debt service coverage ratio loans, or bank statement loans. And before you get upset with me, this is not 2006, it's not 2007. We're not doing 100% financing, stated income, bank statements loans, nothing like that. These are very high quality loans. These are folks that are self-employed, they run a business, they show $8,000 a month in deposits. They just have write-offs where they don't show enough income on paper to get conforming conventional financing. And so we're using bank statement loans where they're putting good down payments, they've got good credit, we're proving their income through bank statements. So that's all that is. And so these are the 2 products that I'm gonna give a little bit of insight in. I'm gonna talk about what's needed for them. I'm gonna talk about how they work, who might qualify. And if you have any questions at all, as always, Matt, M-A-T-T, at mattthemortgageguy.com. That's if you're gonna do something in California. If you're outside of California, let me connect you with a great broker in the state you're in, greatmortgagebroker.com. 6 quick questions and you're immediately connected with somebody in your state. And I've got great feedback so far. Somebody told me the other day that they reached out at a crazy time and got connected with U Mortgage at a time they didn't expect to reach somebody. So you're gonna be treated well. If you don't, I cut off those folks that I'm referring to. So without further ado, let's talk first about debt service coverage ratio loans. These loans are gonna be used by investors. And investors, when they look at an investment, debt service coverage ratio, fancy way of saying, is the rent more than my payment. That's all that is. And so to get that ratio, you look at the market rents, and when we do an appraisal, they do what's called a rent schedule, a 1007, where it's gonna say, this property type in this area, market rent is $2,500 a month. If your principal, interest, taxes, and insurance payment is $2,000 a month, guess what? That's a 1.25 debt service coverage ratio. Anything above 1, you're going to qualify. I've got this lender that I send business to will go down to 0.75. You'll have to put 30% down to get that 0.75, which would mean like you're only getting $1,500 in rent and it's a $2,000 payment. Let me tell you something, you would never buy that. Never, ever, 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 ever. Even if you expect appreciation, or I don't even know what the reason would be, right? But a good thing about some of these loans is the deal has to make sense as an investor for a company to actually give you the loan, which is a good thing. Might protect you against getting into a bad deal. So your rent is more than your payment. It's that simple. And that's what they're looking at. They're looking at that. They're looking at down payment. They're looking at credit score, and then voila. And I know people are going to ask me, like, what are the rates? What are the rates? What are the terms? Depending on credit score, depending on down payment, depending on all that, these loans are going to range anywhere from 4 to 6%. If you're putting the minimum down and you've got a 660 credit score, then you're going to be higher to 6. If you're putting 50% down and you've got a 780 credit score, you're going to be closer to 4. It's going to be somewhere in there. For somebody who doesn't qualify for conventional financing, just for comparison, a great looking loan for an investment property when you're putting 25% down and you qualify for conventional is going to be mid 3s anyway. So it's not like we're that far off. to be in the mid 4s or 5% or somewhere in there, right? For most folks. So couple things to note. If you're above that 1.0, your max loan to value is going to be 80%. Like I said, if you're below that 1.0 debt service coverage ratio, you probably want to think twice about the deal. You can still get financing. You're going to put 30% down. A couple things to note as well is that both on the DSCR and the bank statement loan, your down payment funds only have to be seasoned for 10 days. On conforming loans, you got to show 2 months of bank statements, quote unquote, seasoned for 2 months. On these loans, just 10 days worth of seasoning. We got to show that's been in your account for at least 10 days. 6 months of reserves. You've got a $2,000 payment. They want you to have $12,000 in the bank or in some sort of investment account, somewhere where if stuff goes haywire, you've got enough to cover rent for 6 months. A good idea as an investor in general. Okay, bank statement loans. These are super, super simple. You send us 12 months of bank statements, and some programs, they want to see 24 months. You show that you've been self-employed for at least 2 years, and then other programs, other lenders want you to be self-employed for 4 years. We just look at your deposits. January, February, March, April, May. $7,000 this month, $9,200 this month, $11,000 that month, $6,600 that month. We take all that, and let's say it totals $150,000. We can use an expense ratio of 50%. They're just going to assume that you've got expenses of 50%, and $75,000 for the year is going to be your income. Divide that by 12 and it's $6,200 a month or whatever it is. And that's your income. And then you're going to qualify like you would on a regular loan using that $6,200 a month as income. Hopefully that makes sense. If you wanted to get an exception and you're like, I don't have expenses that are 50%, your CPA writes a letter and says, hey, listen, my client is a translator. They don't have expenses. Their only expense is their gas driving to court. And your CPA says, their expenses make up about 10% of what they earn. Okay, we can use that with a CPA letter. So that's it. To see if we can do a loan, a bank statement loan, this is what I have people send me. A copy of their ID, 12 months of bank statements, any mortgage statements or hazard insurance statements from current properties they own, and a borrower's authorization. This and maybe a loan app. And we'll be able to send this to the lender. They'll look at those bank statements and they'll say, this is how much we can give you. We'll plug that in income-wise, and we'll say, yes, we can get you a loan. We'll look at the matrix based on your credit score, based on your down payment, and say, this is the terms you're gonna get. Same thing for the debt service coverage ratio loan. If you're in contract on something, you send us the purchase contract, you send us no bank statements, but we wanna get an idea of what the rent schedule is gonna come out, what it's gonna rent at, and we can figure out if that's gonna be a deal there. Super easy loans, if you fit in these buckets, slightly higher rates than conventional, but these are products that are made available to investors. And I can tell you, as somebody who doesn't want to put somebody into a high risk loan or a bad loan, like we saw 15 years ago with the last housing crisis, these are safe loans. They're not giving these loans to people with terrible credit. They're not giving these loans to people that don't have skin in the game, significant down payments. And they're not giving debt service coverage ratio loans to stuff that's, an alligator where it's eating you up every month and you're losing money. And bank statement loans, you've got to show ability to repay. If you're getting $9,000 a month deposited in your account because you're running a business, likelihood is with every other box is checked with credit score and down payment and whatnot, you're going to have an ability to repay. So any questions on these, please feel free to reach out. Matt@mattthemortgageguy.com. If you're out of the state of California, I would love to help you, but out of state, they might have specific products for you that are different than they are in California. And so I'd hate to go through a 10-minute consult and then have to pass you off to somebody else. Just go straight to them. GreatMortgageBroker.com. They'll get you dialed in. They'll look at your scenario and advise you on what might work best and show you what programs they have available. All right. Thanks for watching. Bye-bye.